What do you make of all four indices, the three major ones in the Russell hitting highs at the exact same time on the day after the Fed rate cut, when the day of the rate cut, the indices actually closed lower, with the exception of the Russell, I should say?
Historically, over this cycle, particularly, we have seen some very mixed results on the actual day of trading, followed by sort of a decisive result. It was a strange SEP, and I think that a lot of what happened on Wednesday's trading was trying to decipher some of the push and pull of the moves and the conversation that happened versus the actual SEP, which was showing employment going down, but rates cuts going up. So I think there was a little bit of interpretation and a little bit of a wait and see approach from institutional money.
Philip, coming over to you. I want to talk to you specifically about the small caps. In your notes to us, you said you're bullish on healthcare and small caps. So I want to talk to you about small caps and the idea of this being a trade for right now or simply a catch-up trade. We're going to show the moves when it comes to the Russell 2000 since its previous all-time high back in 2021 compared to the NASDAQ. You're going to see here the NASDAQ's far outperformed. What's the argument for small caps when we generally see outperformance from a lot of the other major indices going forward? And again, I think a lot of people see the moves that we're seeing in the Russell recently as a catch-up because the other major indices have hit dozens of record highs this year.
Yeah, Frank, I think it's a great point. I think it's a bit of both, I would say. Look, small cap stocks and companies tend to fund themselves with short-term rates. They usually cannot borrow at the long end, so a change in Federal Reserve policy impacts them more. And so if you look at performance of small caps since the Jackson Hole speech, for example, and you put that up there earlier, have been well supported by rate cut expectations. But I think if you take a long-term perspective as well and look at the long-term valuation ratios do bottom-up valuation analysis. We do still think that small caps, in particular small cap value stocks, still trade at a 15 to 20% discount to their intrinsic value. So I think sometimes you need a catalyst for things to for valuations to converge. And we think in this particular case, Fed easing can be that catalyst.
All right, Ali, I think just about everybody's looking to put money to work somewhere right now, whether it's the equity market, the bond market, commodity market. I want to focus on the equity market for just a second. I'm going to play a soundbite from David Tepper of Appaloosa, what he said about the current market and the rich valuations. Actually, we're going to come to that in just a minute. I want to ask you, actually, how do you see the market right now, the valuations, again, the major indices hitting all-time highs? We did have some guests on this week that said the idea that if we're in a rate cut cycle, that makes these valuations a bit more palatable. Do you agree with that sense that even though the market's trading at pretty close to a historic high, if we are actually going to get rate cuts later this year, that this valuation is a bit more acceptable?
Firstly, I did see David Tepper's comments, so I can talk to those even though we didn't show them. And here would be my response, which is similar to his. Although, we haven't traded at over 21 times and we're close to 23 times, but 4 times in the last 75 years, and the results from that are mixed. They are not mixed, or said another way, they are conclusive to the upside when you are in earnings expansion and rate cutting environment. So this is nosebleed territory, but I think this is not the time to fade the Fed, or as he alluded to fade the FOMO of all of the cash that has been waiting and piling up in money markets, which is undeniably going down. So yes, this is a precarious position. The market is a little untested, but there are so many tailwinds, whether it's in the form of the AI revolution, the stimulus coming from the big, beautiful bill, a probably more aligned and more political Fed going forward that's going to have a greater sense of alignment in terms of the policy that the administration wants. So as much as it hurts, this is the time when you have to get into buying the dip, dollar cost averaging, and staying strong and uncomfortable.
All right, Philip, coming back over to you again. If we're going into a rate cut cycle, what areas of the market do you want to play right now? Is it mega cap tech? Is it cyclicals? Is it perhaps a catch-up trade, as you mentioned, with small caps? Or some of the other unloved sectors like healthcare, real estate, et cetera?
Yeah, so as I mentioned, small caps, I think, is kind of the pro-cyclical trade that we have on that I think is kind of consistent with the bullish mood. At the same time, I will say that, markets are kind of priced for perfection. And so in that vein, having some defensiveness in the portfolio, I think, makes sense. I think healthcare, in our estimation, is one of those areas that has lagged behind and actually has strong fundamentals. We have seen some regulatory concerns there, but it's the only sector year to date that is still trading in negative, and we think that's not consistent with the underlying fundamentals of that sector.
Almost out of time. Very quickly, got to talk to you guys about gold. Philip, you first. A lot of price targets, including Jeff Gundlach and Deutsche Bank, see gold going to 4,000. Very quickly, would you buy gold, which is also generally in nosebleed territory right now?
I would not buy gold right now. I think it's quite expensive, and we don't buy.
What about you?
You absolutely have to buy gold. Waning dollar, increasing central bank, a lot of risk out there. Got to buy gold.